Thanks so much for tuning into this very special conversation. And I call it very special because it's important to learn from people who know. Now, before understanding or before deciding whether a Zomato or any of the other consumer tech companies should be in your portfolio or no, you first need to figure out how to value this business in the first place, right? And then figure out whether it's valuable enough to have or not have. Now, our guest today, Ramesh Mantri, did this very popular or a webinar on BUH, which became subsequently very, very popular. And we thought it was best to get him to try and understand how to value consumer tech. Ramesh, so good having you. Thank you so much for joining in.
Thank you, Neeraj, for the invite. Pleasure being on the show.
The pleasure is ours. Now, I want to start this off by a tweet that Ashish put out yesterday, your colleague Ashish put out yesterday, Somaya. He says that the criticism suggests that we are comfortable dragging Excel of Myra rates if the company has been profitable or has had a familiar script. But we are unable to envision scenarios which haven't evolved as per a familiar script and can't be extrapolated linearly. Would you extend this to how people are trying to either rubbish or extend their belief towards Zomato or any of the future consumer tech companies that are slated to come up with IPOs?
Sure, thank you. So Neeraj, see, this issue has to be addressed at multiple levels. First level is that Indian investors have not been used to loss-making companies going public. Many years ago, regulations didn't even allow loss-making companies to go public, and because the regulations were pretty different and demanding for loss-making companies to go public, we haven't seen much loss-making companies in India go public. And that's why there's a discomfort between the larger investor base on how to look at loss-making companies. This isn't true for, let's say, some markets like US, where it's been a phenomenon for the last 50 years, or China. So one is just the lack of familiarity with the whole financial model. Number two is also lack of familiarity with the economic model. And I'll explain this in slightly more detail. See, what happens is, let's say when a traditional company builds a factory, we capitalize that, and the value of the factory gets depreciated over 20 years, 30 years, the useful life. What does consumer tech companies invest in? They invest in great technology. They invest in customer acquisition, and they also invest in generating a great customer experience. However, as per traditional accounting, these are not assets. These are expenses. So in traditional accounting, building great technology, having a lot of customers and happy customers is not an asset, or having a great brand is not an asset, it's an expense. So it's in many ways the flaw of traditional accounting. And by the way, that's globally now slowly changing. So the construct that these companies invest in, the assets, and we all know intuitively that great technology, a large happy customer base is an asset, is a very valuable asset. However, just because of the construct of accounting and the fact that India, we haven't seen these kind of companies as yet in the public markets, not many of them. So we're just not comfortable with these new scenarios. That's where Ashish's comment comes in, that we're used to traditional profit-making companies, but we are not able to envisage discontinuous futures, right? And the world is changing. Also in the world, at the margin, the value is shifting from physical goods or properties like real estate to ideas and intellect. Look at the most valuable companies in the world, whether Apple, Google, Amazon, their ideas and intellect. In fact, a company like Facebook or Google can actually operate with zero assets and yet be extremely valuable. So the value is shifting from physical assets to ideas and intellect. And this is the discontinuity we are all facing as investors. And of course, it's always not easy to deal with discontinuity. So that's where Ashish's comment comes in.
And I would love to understand where your comment comes from. And I would get to the Zomato or the consumer tech valuation in just a moment. That's the most important part. But just wondering, if you were betting on this issue or any other issue, and strictly, I do not want to get into a conversation about whether you believe Zomato is a buy or a sell or a hold. I don't want that to be a part of this. So viewers, please log off if you want to know whether you should subscribe to Zomato or not. This is more a learning thing. But Ramesh, the question is that if you were a believer is the underpenetration, relative underpenetration of almost all of these businesses or these industries a big factor, or is it something else?
See, I think one clearly is the size of the economic opportunity, and I think the country to look at, for example, is not US, because US is like 40, 50 years ahead of India, in terms of its economic evolution. But one country is very similar to India and probably a decade ahead in a lot of these categories is China. And look at the penetration of China in a lot of categories. Just look at e-commerce. US is at 19%, China is at 35, and India is at 5. And by the way, China started much later than US on the e-commerce journey. And there are certain aspects about China why e-commerce is a larger category in China today than in US, and the same attributes apply to India. See, countries like China or India, which are highly densely populated, right? Real estate is very expensive in relation to per capita income. That phenomena is opposite in US, where real estate is cheap in relation to per capita income. So in India or countries like China, it's not possible to kind of build the kind of physical retail that US has built because we just don't have the space. And if the space exists, it's very expensive. While e-commerce suits to the Indian requirement that e-commerce does not consume real estate, prime real estate, and it consumes a lot of, delivery services where labor is still India cheap relative to real estate. And that's why we can understand why China significant scale up has happened for e-commerce. And that exact phenomena is likely to play out in India. Simply e-commerce is short on real estate and long on labor, which is what suits India.
Yeah, well put, and yeah, and clearly a defining point of sorts for these businesses. Now, how to value them, and I really want to understand from you because the most abused way of rubbish, at least in the retail format of either rubbishing the Zomato IPO or not. And frankly, it's not just retail. A lot of other people and so-called experts are putting it out on social media as well. It's a loss-making business. Why do you want to invest? And why do you want to give it a value of whatever X billion dollars? Please comment on this. How are you going about valuing any of these businesses? And if you can also tell us a little bit about Zomato, great. But start off with the whole pack, if you will.
Sure. So see, the first is, I think when we talk about a lot of people, is just the lack of familiarity with loss-making business models. One, IPOs in India, we haven't had a history. Number two phenomena is that I said, right, new tech companies where the investments, see a company like Zomato or a lot of new tech companies or even Paytm or Flipkart are actually investing currently in the habit formation stage. They're building these habits in India, very, very early stage at e-commerce 5% penetration. And how does investment in habit formation happens? Through investment in technology, investment in great customer experience, right? That's what they're doing. They're in the investment phase. To give a very different analogy on losses and profits, and I come from very different. Let's say someone is studying for a MTech engineering in a best-in-class institute, right? Gets enrolled, and they have to study for 6 years. For 6 years, there'll be losses, right? Because don't make any money in the first 6. But anyone in a sane mind knows it's an extremely positive decision. It's a valuable decision because the income streams are there for next 40, 50 years. The same analogy, just because there are losses today does not mean there are going to be losses in the future. And valuation of all businesses comes from the fundamental value equation. The value of any business is the present value of its future cash flows. Remember, just because a company has profits today, there's no guarantee it'll have profits tomorrow, by the way. And even if you don't invest in some of these new tech companies, we need to understand all of them because they will disrupt the existing profit-making companies. Will e-commerce on Amazon not impact some of the brand CPG companies? We have to evaluate that. Would fintech not hit the profit pools of large banks in India? It's already happened, right? And the same would happen, let's say e-pharma not impact some of the pricing power of pharma companies. So you have to think, anyway, understand these businesses because otherwise your existing profit pools will get impacted. So that's an important construct. So going back to the valuation principle, the value of any business is the present value of free cash flows. So just because there are losses, I would actually call them investments for many of these companies. That's the right word to use, right? They're building the business, they're building habits. So the value of any business is the present value of future cash flow. So what we do is you build a long-term DCF model. For example, just going back to Zomato and taking again China in the context, the current size of food delivery market in China is 20 times the size of India. Let's say India gets to that size in 15 years. The current size of China, I'm not saying the future size of China.
Yeah.
Even then, the food delivery business in India will grow at 20% CAGR. For 15 years, it's hard to find a lot of consumer companies which are even growing in even in mid-teens in India sustainably for longer periods, right? So you have to have that context. Number two, these companies, what you need to focus is the unit economics of the underlying businesses. Like, for example, the number that's relevant for Zomato is contribution margin per order. That number used to be, pretty poor, before the pandemic happened. And COVID has clearly accelerated the behavioral transformation. Because remember, in food delivery, the only time you want to enjoy good food during the pandemic was to order on food delivery apps. So a lot of people have adopted these habits. And suddenly the economics from losses per contribution per order has suddenly shifted to positive. That's the key number to watch. Because as the number of these orders scale up massively, there are, of course, overhead costs below this, right? But these will tend to grow at slow rates while the orders and traffic is going to grow at much higher rate. So if these contribution margins are sustainable, right, then these companies in a few years will start turning in large profits. Any such industry, of course, a lot of value gets created more if one dominant player emerges. Technology has the habit of creating leaders, strong leaders in industry segments. So if Zomato or Swiggy, one of them emerges as a leader, the business becomes more valuable. And there's very important aspect of the business that we are not talking about, and we're all fixated about food delivery for a company like Zomato and Swiggy. What are the strategic assets of Zomato or Swiggy currently? They have deep tech stack, build hyper-local deliveries in a country like India where logistics is very difficult, and have very happy customer base. And of course, a management team, credible management team. These four can be implemented to sell different products and solutions to customers. For example, something that Swiggy started doing in Zomato is experimenting with grocers, is getting into groceries. And there are more adjacencies possible because customers today per se, trust Zomato and Swiggy as brands, and it's difficult to value trust, but everyone knows it's a very valuable attribute. And this is what exactly happened in China, by the way. Meituan, which is the most valuable food delivery company, the best performing food delivery stock, they started with food delivery and have got into adjacencies, have done a good job, have emerged as a market leader, and have created a lot of shareholder value.
Ramesh, the counter to that would be that quite unlike China, which is a bit of a closed economy for these domestic tech players, in India, Zomato, while it is the leader in food delivery, for the other adjacencies, it will go up head to head against a lot of big guns. And even in its own domain, Amazon, for example, recently announced, I'm sure you know, that the Prime members, the food delivery will be free. There is talk that Reliance might buy a Just Dial and could it use that database to improve the grocery delivery piece or start that grocery delivery piece with much more vengeance, and that is a deep-pocketed rival too. So if you're betting on Zomato, is your bet on it being able to grow the food delivery business where it is the leader exponentially, or is it that adjacencies will come in and help the unit economics of Zomato?
So I would say, of course, the key vector is food delivery for growth, which is where we are clearly joint leaders with Swiggy, right? And that's, of course, as I said, can be a very large opportunity. But there's clearly a potential to build adjacencies. And Neeraj, you're right. As of now, we are in the early land grab stage in grocery, where you have Amazon, Flipkart, JioMart, you have Tata's now coming through Big Basket, Grofers. So it's going to be very competitive. A lot of capital will get deployed in e-grocery and some of the other agencies. But remember, finally, the capital does not win wars of the heart of customers. Ultimately, the mindset to deliver great customer experiences matter. So we have seen it. We have seen SoftBank funding a lot of companies. Some of them done well. Capital was not the only way to compete. It's actually the way we've delivered customer service, how we've executed. And one of the things we can appreciate about Zomato and Swiggy has been that they have very focused on customer experience and have done a great job of execution. So ultimately, and by the way, capital is also available to these companies. Zomato will have 15,000 crores on their balance sheet post the IPO.
Yeah, that's true. A quick follow-up there, Ramesh. Uh, do you reckon that in your models, when you build them, if you build them, again, I'm not making any presumptions here, are you building in the unit economics and the metric that you mentioned to improve, not gradually, but maybe with a hockey stick, or even gradually over a period of the next 5-10 years, purely within the existing setup of businesses that Zomato has? I'm just trying to understand if that is happening on your laptop.
Sure. So once, if you think about how Zomato or any food delivery company makes money, they make money through three ways. One is take rate, the money they get from restaurants; customer service charges, which incidentally we have got used to paying in the last 1 year and paying more. Again, habit formation, validation of habit formation. And third is advertising. And advertising has hardly started in India, by the way, on the app, which over longer term can be a reasonable revenue driver for these companies. And on the cost, the key cost is the cost of delivery. As the density of orders go up, right, the cost per unit will fall. Simply because one building today gets 5 orders in the evening. In 10 years later, if they get 25 orders in the evening, more orders will get batched up and cost per unit will fall. So there is a benefit below the line on the cost side. The scale economics will come. Similarly, overheads and marketing cost will come down as a percentage of revenue. So that is where the delta will come. Your contribution margin per order doesn't have to go up, and we are not believe that is a likely large lever. But surely the scale of business. Remember, if a business can be a multiples of today in a decade's time, just that the operating leverage because of the variable margin per order can over time create a lot of value. And of course, as I said, we are not even talking about adjacencies here.
That's true. Okay, then one final question then, Ramesh. How does all of this, let's assume that this plays out as what a lot of people who are bullish on the product are penciling in. How much of that does it discount at the valuation that it is IPOing at, or it will list at? And again, I'm sorry this has become a Zomato conversation, but the others haven't come in with their IPOs, so we can't quite have a conversation on their valuations. Maybe we can do one later on as well on the whole consumer tech piece. But do you reckon that these companies are coming in at very sky high valuations, discounting multiple years, or growth will take care of it?
So, Neeraj, I would choose not to comment on specific valuations of individual companies.
No, you're right. Sorry, excuse me for that. Excuse me for that. Okay, then one last question. What are the risks? Just very quickly, what are the risks to this? Is it the risk coming in from other large global players getting into the business and increasing the burn rate, or is it something else?
See, one is what Swiggy and Zomato build is very credible assets, whether hyper deliver capabilities, technology stack, happy customers, trustworthy brand. The only company that really has the ability to take them head on, at least from the current Indian context, is Amazon. And they are running an experiment in Bangalore as we speak. By the way, Amazon has pulled out of food delivery earlier in UK and US. So it's not like Amazon is a given winner. But they are one capable company. And of course, there are lateral, orthogonal competition from direct-to-order platforms like DotPay, Thrive, which are, encouraging individual restaurants to go direct to consumer. See, in India, the restaurant ecosystem is very fragmented. We don't even have, we probably can count on our hand the number of large food delivery chains in the country. So it's a very fragmented restaurant base. So only a few of them will be able to go direct to the consumer and adopt technologies. And we'll have to see how these companies behave. They can be at the margin a risk. And ultimately, the value will get created if one of them emerges as a leader in the space. The big value will get created. But I would like to say that while this is something that we know, there are very large and interesting IPOs that will come in India even in the next few months. And many of those companies are already leaders in what they do. For example, you have Nykaa, you have Policy Bazaar, you have very interesting company Cartrade, and also a company in travel tech called IXIGO. So you're going to see a set of companies which are clearly emerged as leaders in the segments they operate in. So you, as investors, the key focus has to be one, identify dominant companies in fast-growing large markets, companies with positive unit economics that are trying to solve problems with technology, and credible management teams. And if you stay long-term invested with these kind of companies, value will get created, as it has been with InfoEdge, IndiaMart recently.
Got it. Ramesh, this was insightful. Thank you so much for taking the time out and speaking to us. Really appreciate you joining.
Thank you, Neeraj, for inviting on the show. Have a nice day.
It was ours. Thank you. You too. Viewers, thanks for tuning in.